Sir, is it possible to invest in gold through mutual funds?
Yes, pretty much. So the gold can be invested through mutual funds also or through ETF. So
Okay.
when they are investing, this is actually in the form of paper gold. Basically, gold ETF is a requirement where you need to have a demat account. So
Okay.
through using the demat account, one can buy gold ETF. But if they don't want to, carry a demat account and then trade, they have to punch in the trading as well. So wherein here in mutual funds, they will actually invest in indirectly into gold ETF. They'll be directly investing in gold ETF only to get the benefits of gold. So this will track the 24 karat gold price. That is 99.99 purity
Okay.
of gold is what actually they will be tracking. So whatever the gold ETF gives the return, whatever the gold prices moves ups and downs, based on that only the returns on gold mutual funds will be given. So when investing in gold mutual funds, one has to look at what is the tracking error or what is the expenses. So when we are talking about tracking error, see basically investing in gold. So you are giving the money to the fund manager today. But if the fund manager invests, let's say, after a week or, after 10 days or something, so there could be a gold prices which will move up and down. So that tracking will have an impact on their returns. So that is the reason why when somebody is investing in gold ETF through mutual funds, they have to use the tracking error. The minimum the tracking error, the better the tracking will be. And the expenses, yes, of course, since the fund managers are managing it, they have to look at the expense ratio as well. The minimum the expense ratio, the better the return on gold mutual funds.
Actually, my father is a retired person and he is getting regular interest from the banks. So, is there a possibility that he can get the same arrangement through mutual funds?
Since he is retired, so most of the retirees prefer to invest in fixed income product through fixed deposit. So ideally, the fixed deposits will be delivering about 6 to 7% return, and that is what actually they will be getting on as a interest on a either monthly basis or quarterly basis that can be decided by the investor. But what happens is, so when they are getting let's say 7% returns and the inflation is 7%, and it will also be taxed at, let's say based on their tax slab, assuming even if they are in 20% tax slab, their returns are basically not beating the inflation. That's it. So out of 7%, 20% taxation goes, they will get only 5.4% impact. So this 5.4% versus 7% inflation, it is not beating the inflation. They are indirectly they are eroding their capital without even knowing that. Instead, they can use a systematic withdrawal plan using mutual funds. So how does systematic investment plan works in mutual fund? Is basically they can invest a lump sum amount and then they can start withdrawing on a regular basis. Assuming they can invest in, predominantly they can look at investing in a combination of equity and debt funds, and then this is called as hybrid funds. Either they can invest in hybrid equity or balance advantage fund. They can start withdrawing, you know, on a quarterly basis. 2% on a quarterly basis will prove to be a better, solution for taking the corpus. Along with that, there is a potential of these funds to deliver 2% higher than whatever the systematic withdrawals that they are taking. Ideally, all these hybrid funds used to deliver about 10 to 11% return. So even if they are withdrawing 8% return, still there is a possibility of capital growth of 2 to 3%. So in FDs, the capital growth is not possible at all. Whereas here, the capital growth also, there is a possibility. But again, it is subjected to market risk. Whatever the market returns are, is what actually we'll be getting. But one thing is very clear, if they stay invested for a long period, let's say about 7 years or 10 years, then there is a potential to get a, the 2 to 3% growth in the capital is the possible.